Wake up. It is January 30th, 2026. And if you think the biggest threat to your 401k is interest rates or corporate earnings, you are looking at the wrong map. 2 weeks ago, at the World Economic Forum in Davos, the unthinkable happened. It sounded like a joke at first, a bad reality TV outtake. But when the President of the United States stood on the global stage and effectively demanded that Europe hand over Greenland or face economic annihilation via tariffs, the room didn't laugh. The room went silent. And then? The money started to run. We aren't just talking about a political gaffe here. We are witnessing the final fracturing of the transatlantic alliance that has held the global economy together since 1945. While the mainstream media is busy making memes about Greenland 2.0, the smart money is terrified. Why? Because the trust is gone. And in the world of finance, trust is the only thing backing the US dollar. Right now, as we speak, the European Central Bank is locking itself in a bunker in Frankfurt. They are freezing interest rates at 2%, terrified to move. The euro has smashed through the $1.20 ceiling, crushing the US dollar index. Europe is panic signing trade deals with India and South America, desperate to cut the cord with Washington. If you are holding US stocks, US bonds, or just cash in a savings account, you are standing on a fault line. The transatlantic trade pact signed last summer is on life support. If Trump pulls the plug, which he has signaled he might do at any moment, we aren't looking at a correction. We are looking at a supply chain heart attack that makes 2020 look like a picnic. In this video, we are peeling back the layers of this geopolitical nightmare. We're going to look at why the ECB is paralyzed, why the dollar is bleeding out, and most importantly, how you position your portfolio before the February 4th central bank meeting seals our fate. Welcome to the endgame of globalization. Let's follow the money. Let's rewind to the Greenland incident. You might be asking, why does a viewer in Ohio or London care about an Arctic island? You care because it was the catalyst that exposed just how fragile the global order really is. When the US president threatened to renege on the trade pact established in the summer of 2025, he didn't just threaten Europe, he threatened the predictability of global commerce. Markets hate bad news, but they loathe uncertainty. And right now, we are drowning in it. According to a massive poll of economists released by Bloomberg this morning, geopolitical tension is at a 2-year high. But here is the nuance that Wall Street is whispering about: Europe isn't just taking the abuse anymore. They are pivoting. In just the last 7 days, Brussels has rushed to sign a massive trade accord with India. Earlier this month, they locked down a separate pact with a bloc of South American nations. Do you see what's happening? For decades, the global supply chain was a straight line: the US consumes, Europe produces high-end goods, and Asia manufactures the cheap stuff. Everyone used the dollar. Everyone was happy. Now, Europe is building a firewall. They are fortifying partnerships that exclude the United States. The wallet connection: imagine you own shares in Ford or General Motors. If Europe shifts its automotive supply chains to India or South America to avoid US tariffs, American companies lose access to crucial German engineering and raw materials. Cost of goods sold skyrockets. Margins collapse. Stock prices tank. Swedbank economist Narigis Maciulis put it bluntly: the first weeks of 2026 have clearly illustrated that trade deals and agreements remain very fragile. Fragile is central banker code for about to break. 76% of economists still think the US-EU trade deal will survive. But here's the kicker: that number is dropping. Gavin Friend, a senior strategist at National Australia Bank, calls it a near-death experience. Do you want your retirement fund betting on an asset that is constantly having near-death experiences? The world is realizing that the US is no longer a reliable partner. And when you stop being a reliable partner, people stop buying your currency. Which brings us to the most dangerous chart on your screen right now. Look at the euro to US dollar chart. The euro has appreciated 15% in the last year. It just broke the psychological barrier of $1.20. For the uninitiated, a 15% move in major currencies is like the stock market moving 50%. It is massive. It is violent. Why is the euro rising? Is it because the European economy is booming? Absolutely not. Europe is sluggish. Germany is barely growing. The euro is rising because investors are fleeing the dollar. This is a capital flight scenario. Global money managers are looking at the political chaos in Washington, the threats of tariffs, and the erratic foreign policy, and they are saying, I'm out. Deep dive: the mechanics of the crash. When the dollar drops 15% against the euro, 2 things happen immediately that affect your wallet. 1. Imported inflation: everything the US buys from Europe, pharmaceuticals, industrial machinery, Italian wine, French luxury goods, just got 15% more expensive. This reignites inflation in the US, forcing the Fed to keep rates high, which chokes off the housing market. 2. The exporter's nightmare: on the flip side, this is a disaster for Europe. German exports rely on being competitively priced. If the euro is too strong, nobody buys BMWs or Siemens turbines. This creates a paradox. The euro is soaring while the dollar is tanking. It is a lose-lose scenario driven entirely by political fear. Ilias Tsirigotakis from the National Bank of Greece calls a rapid US dollar depreciation a fat tail event. In finance, a fat tail is a catastrophe that statistical models say shouldn't happen, but when it does, it wipes everyone out. Think 2008. Think COVID. We are staring at a fat tail right now. If the euro hits $1.25, which Gavin Friend from NAB suggests is manageable, the European Central Bank will panic. A currency that strong acts like a chokehold on their economy. It makes their goods too expensive for the world to buy. So, why hasn't the ECB stopped it? Because they can't. They are trapped in a monetary prison. This coming week, February 4th and 5th, the Governing Council meets in Frankfurt. Every single economist polled predicts the deposit rate will stay at 2%. Unanimous. Usually, when central banks do nothing, it's because things are boring. This time, they are doing nothing because they are terrified of making a mistake. The Lagarde trap. Christine Lagarde, the head of the ECB, is playing a high-stakes game of poker with a bad hand. Option A, raise rates. If she raises rates to defend against inflation, she crushes the fragile growth in Germany and France. The economy dies. Option B, cut rates. If she cuts rates to stimulate growth, she devalues the euro. Normally, this would be good. But if she cuts too fast while the US is acting crazy, capital might flow out of Europe too quickly, creating volatility. Plus, traders are already betting on cuts. If she cuts, she admits the economy is failing. So, she chooses option C, do nothing. Hope the US trade deal holds. Hope the euro stops climbing. But hope is not a strategy. The data shows that the hawks, the officials who want higher rates, are getting quieter. The calls for rate hikes in 2026 are receding. The reality is setting in, Europe is facing a structural slowdown. The sick man returns? Let's talk about Germany. The engine of Europe. It has lagged behind its peers for years. It only just returned to growth. Bloomberg Economics points out that the only thing keeping the European economy afloat right now is a massive fiscal impulse. What does that mean in plain English? Government spending. Specifically, spending on infrastructure and defense. Since the geopolitical situation is deteriorating, European governments are printing money to build tanks, drones, and energy grids. This is the only reason Germany is projected to benefit more than the rest of the Eurozone. They are remilitarizing and reindustrializing on the taxpayer's dime. This is a clue for your portfolio. If the private sector is dying but governments are spending billions on defense and infrastructure, where should your money be? Not in consumer discretionary stocks. It should be in European defense contractors and heavy industry. Tickers like Rheinmetall or Airbus are the beneficiaries of this fiscal impulse. So, where do we go from here? We have a paralyzed central bank, a dying dollar, and a trade war hanging by a thread. Let's look at the three scenarios for the next 12 months, ranked by probability. Scenario 1, the slow bleed. The ECB holds rates at 2% through 2026. The US-EU trade deal survives in name only. Trump tweets threats, but doesn't pull the trigger on full tariffs. The result, the dollar continues to weaken slowly to $1.25 per euro. US inflation stays sticky around 3 to 4% due to import costs. The S&P 500 trades sideways, chopping up investors who are used to the stonks only go up era. Winner, gold and international equities. Loser, US tech stocks reliant on European revenue. Scenario 2, the trade war explosion. Trump follows through. He tears up the pact because he didn't get Greenland. The result, chaos. The euro spikes to $1.35 as investors dump US assets. European exporters crash. The ECB is forced to panic cut rates to 1% or lower to save their export market. The S&P 500 drops 20% in a month. Winner, volatility, US Treasury bonds, Bitcoin. Loser, everyone else. Scenario 3, the miracle reversal. Cooler heads prevail. The US realizes it needs allies against China. The trade pact is strengthened. The result, the dollar rallies. The euro drops back to $1.10. Business as usual resumes. Winner, the S&P 500, German auto manufacturers. The analyst consensus, most economists are betting on scenario 1, but tilting towards scenario 2. National Australia Bank says the trade deal will go through several near-death experiences. Karsten Brzezinski from ING notes that the ECB has become a beacon of continuity simply because the rest of the world is insane. They are betting that Europe's structural weaknesses, their aging population, their lack of tech innovation, will eventually stop the euro from rising too high. Basically, the bet is, Europe is bad, but the US is currently scarier. Let's bring this back to your kitchen table. You are seeing headlines about GDP and basis points. Ignore them. Focus on purchasing power and asset allocation. If you are a US investor, your currency is being devalued by geopolitical incompetence. The Greenland moment was a signal that the world is tired of the dollar's drama. 1. The home bias trap. Most Americans hold 95% of their net worth in US dollars. If the dollar enters a secular decline against the euro and emerging currencies, you are losing global purchasing power even if your stock portfolio is up 5% in nominal terms. Action: you need international exposure. Europe is pivoting to India and South America. Look at ETFs that track the Nifty 50 or emerging market indexes. Follow the trade deals. If Europe is buying from India, you should own India. 2. The defense play. We mentioned the fiscal impulse. Governments are the only spenders left in the room. Action: research the defense and infrastructure sectors in both Europe and the US. When trade wars heat up, nations build walls and weapons. It's grim, but it's profitable. 3. Watch February 4th. Pay attention to Christine Lagarde's speech on February 4th. Do not listen to the rates unchanged headline. Listen to the Q&A. If she mentions exchange rate monitoring - the euro is too strong, they might intervene. Dollar rallies. If she says geopolitical risks are elevated - they are scared. Gold and Bitcoin likely rally as safe havens against fiat stupidity. 4. The yield curve. Traders are betting on rate cuts in Europe later this year. If Europe cuts rates while the US stays high, the dollar might catch a temporary breath. But if the US economy slows down and the Fed cuts too, it's a race to the bottom. Bloomberg Economics summed it up best this morning: the ECB will continue trying to focus on the forest instead of the trees. That means it will probably shrug off the recent trade dispute linked to Greenland. However, these developments underscore that downside risks to the economic outlook are building. Translation? They are ignoring the warning signs until the car crashes. The Greenland incident wasn't a quirk. It was a tremor. The tectonic plates of the global economy are shifting. We are moving from a world of cooperation to a world of coercion. The deposit rate at 2% isn't safety, it's the eye of the storm. Don't be the investor who waits for the official announcement on CNN. By the time the breaking news banner runs, the 15% currency move has already happened, and your purchasing power has already vanished. Watch the euro. Watch the trade deals in India. And for the love of your portfolio, diversify out of the chaos. I'll be live streaming the ECB decision on February 4th right here. If you want to survive the financial volatility of 2026, you know what to do. Hit that like button if you want to keep your money safe, and subscribe so you don't miss the alert when the next shoe drops. Class dismissed.